Hi, it's John Kelly. In this module, we are going to discuss fraud in revenue recognition. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, not long ago, a practice inspector asked me why we did not automatically assess risk of material misstatement for all assertions for all clients for revenue as high. And she said that other auditors did this, and she said that standards required this. Now, the standard that this inspector was referring to was created because of some research that found that many frauds occur in revenue recognition. Now, the same research found that many frauds also occurred in other areas, but the standard setters, influenced by Sarbanes-Oxley, picked up on the revenue recognition part. Now, the reference in standards is to 240.26, and that tells the auditor that we are to presume risks, not high risks, but presume risks of fraud in revenue recognition. And this is a rebuttable presumption. So if we think about it and have reasons that we think we have rebutted the presumption, we document that and then proceed to assess risk of material misstatement for revenues in the normal fashion, which could include risk of material misstatement being low. Now, particularly important that we document it because it says we shall presume, and it says we shall document the reasons. So it would seem to be a good idea that we should have a checklist prompt someplace in our completion checklist saying, did we think about the risk of fraud in revenue recognition? And if we rebutted that presumption, did we document our reasons? Or perhaps we could have that on the revenues audit program, or perhaps for additional safety, because it's so important to document this, we might have it in both places. Now, the interpretation of this section is the section clearly says that this presumption can be rebutted. And further, the section does not say that we are to presume high risk of material misstatement, just to presume risks. And indeed, 240A30 says there are circumstances where there could be no risk. And the example given is leasehold revenues from a single unit rental property. The interesting thing is the audit file being inspected was basically a larger version of leasehold revenue from a single unit rental property. The other thing we should think about, A28 does say that we should think that there could be overstatement due to premature recognition, and there also could be understatement through deferral. So we need to think about both of those things. Now, the lesson here, I think, to auditors is that the auditor needs to know standards better than any inspector. If I had not known about these paragraphs, I might have unintentionally agreed to do something that I shouldn't have agreed to. So you need to know your standards better than any inspector. Second thing is it's a bad plan to set risk of material misstatements in revenues automatically as high. Because if it's not high, if it's really low, and if you documented that properly and could have audited to low, you're going to end up doing far too much work. The other thing this does is if staff then say, well, I'll assess it as high, but I actually really don't see a problem, so I'm not really going to do much work to solve this problem, we're going to be training staff to do too little work on assertions where risk of material misstatement really is high, and we really need to do a lot of work. So this is training people, and this is auditing without thinking, and that's a bad plan, and we need to stop and think about it, follow the standards, consider whether or not the presumption has been rebutted, and design the audit accordingly. So, in summary, know your standards and document. Very important in this area. So, thanks for listening.